Well, I mean, it is risk and reward, right?
Yeah.
What you're trying to do is find opportunities that are going to pay off. If it wasn't gambling, it would be a guaranteed return, and there's no such thing.
Everybody
really.
would do that. I would
Exactly.
for all.
Founders that ask questions, I always enjoy because that means they have a desire to improve and
Yeah.
learn.
Yeah.
No product and delivery service. There's something about your business that is going to change as you grow, and it should. Because if it doesn't, then you're not growing.
Welcome back, everybody, to the Founders Corner. In today's episode, I have a very special guest here with me. His name is Arden Che, and he is actually part of a group out in Vancouver called Yaletown Partners. And he actually has his own fund that invests in specifically seed to about pre-Series A levels. And we actually brought him on to be able to talk to you guys about what investors are looking for, how to approach them, and what is most important when you're looking at a business, especially at an early stage. So let's all welcome Arden. Arden, welcome. How are you?
Hey, South. Great. Thanks for having me.
Of course.
This beautiful. Is it a sunny Alberta day? I don't
Not
know. It's
not a chance. It's a cloud, and we're getting all the smoke from BC right now. So, as people say, Canada is on fire right now.
Canada is on fire, and so is the Alberta technology scene. There you go.
Wow, we're gonna start it off with a bang. I love it. So,
Awesome.
Arden, why don't you give a little backstory about you and who you are, and how did you get where you are today?
Wow. Okay, that's
I know it's loaded.
Long story short, so Arden Che, I am an investment manager with Yaletown Partners. We have a few different funds, and the one that I manage is called Accelerate Fund 3, which invests in early stage Alberta-based tech companies. So it's kind of like seed to just before Series A. There's revenue there.
Right.
There's some early product market fit. I have been a capital markets guy for pretty much most of my career, over 20 years in finance and investment. So I could be, I'm what you would call an investment guy. I started off in commercial real estate as an asset class. I've worked at pension fund level institutionally, and then I went to public equities. And just by sheer stroke of luck, I managed to get into early stage venture capital.
That is sheer luck. Yeah, that is sheer luck.
It is really, I often say that, getting this job and landing in this industry is like jumping out of a helicopter at 20,000 feet and landing in this cup of coffee. It's it's not an easy industry to get into, but I love it. I've been with Yaletown for 5 years now, and I think venture capital is probably my favorite asset class. And I'm lucky to have gotten to professionally manage a few different asset classes, but this has by far been my favorite. That's for sure.
Awesome. And I could not agree with you more about jumping off. I use the terminology jumping off of a cliff. So I think all founders and entrepreneurs, they're jumping off of a cliff, and they have all the parts to build a plane. Hopefully you build it before you hit the ground. Glide through, right?
Hopefully you never hit the ground.
Hopefully you don't hit the ground, but you got to build it as you're falling, right? So,
but the exciting thing is we get to work with and be up close and personal with the founders, the entrepreneurs, and you really feel like you have that impact, right? Public equities, unless you're a massive hedge fund, you're generally just reading annual reports and looking at the news and looking at investment calls. You're not really close to the asset, and so I found that venture is far more impactful, and I get a lot more fulfillment, if you could say.
Yeah, and especially at the stage you invest in, which is that seed pre-Series A level, you still have that connection with the founder, and you're able to have those conversations with the founder that most hedge funds don't even care to have those conversations, to be honest. And really, they're just placing bets, right? I always say this about investment. I think it's like placing bets, and you're just trying to beat the house, right? And that's the reality of investment, because sometimes it is a gamble. Well, actually, would you say it's always a gamble, and you're just trying to make an educated guess as much as possible?
Well, it is risk and reward, right? Yeah. What you're trying to do is find opportunities that are going to pay off. If it wasn't gambling, it would be a guaranteed return, and there's no such thing.
Everybody would do that. I would for all.
Right. And I think, what separates the gambling from the educated guess part of it is, what's the research that you do? What is your investment thesis? What's your
Right.
discipline, right? What's your process? And I think that is the difference between a professional money manager and somebody who does it for fun, or just kind of, quote unquote, picking winners and favorites, is that you actually have a methodology. You understand what you think it makes a company valuable, what your drivers of value are.
So it's
Right?
interesting that you say that, because I actually think a lot of founders don't realize that investors do have thesis. Investors do have their who do they invest in, why do they invest into it, and it's very, like, a lot of times it's actually quite specific. No, because you are dealing with LPs being limited partners, people who are putting the money for you to invest in it. So you, as the fund manager, I don't think startups kind of see the fact that you also have someone you have to make happy. They kind of see you as, okay, well, look, I can make you happy. It's like, it's not about me. I'm actually trying to make these guys happy.
Well, again, professional, like, we have fiduciary duty. We are stewarding other people's money. And in this
Right.
case, especially for, institutional managers like Yaletown, our clients are pension funds, banks, insurance companies,
Right.
schools, right? Endowments. And so there's a whole other level of analysis and reporting and rigor, which is different from, say, managing private capital. You get a lot of these early stage seed funds where the money just comes from high net worth individuals and family offices, but they don't necessarily have a strict reporting requirement and regulatory issues around them as, say, a pension fund.
Right.
So, that's certainly a difference. I mean, as an angel investor as well, I think this is also a confusion that happens. We talk about myth busting. Angel investors aren't always the same as venture investors.
Yeah.
An individual,
Completely
you can
different in my mind.
for whatever reason you want, right? It could be like, we went to the same school, and your return requirements may be, if you can double my money in the next 10 years, I'm happy. But for a fund manager, we have strict requirements and parameters that we have to hit. And
Right.
so it's not the same. I can't just, look at somebody and go, hey, I think you're a winner, we're going to invest in you. I have to be able to back that up
Yeah.
in terms of how
Because
that
every
fits.
decision has to have a reasoning behind it, right? You can't just
We
be
do a
like,
business.
I felt it.
Yeah.
He was a great founder.
Yeah, exactly. I know how to identify and pick winners. Well, do you? I mean,
Yeah.
it's really hard to go to an institutional investor, like a pension fund, and say, well, you should invest with us because we're just really good at picking winners.
Mm-hmm.
You have to have a thesis, a track record helps.
And I always find whoever says that, yes, they're probably picked a couple of great winners. It doesn't last.
It's hard to. I mean, when you look back to the world of public equities, there's very few active managers that have consistently beat the market over time. If you're lucky, you have a good run, but like you said, there's no one that can do it over the long term. I mean, the best example we always talk about is Warren Buffett, but
Right.
how many Warren Buffetts are out there?
Yeah.
Right. For
Wow.
every one Warren Buffett, there's hundreds of thousands of non-Warren Buffetts.
And to be honest with you, he does not bet. Like, he pretty much, when he bets, it's like he goes in and he's kind of like more hands-on than a lot of people realize. So he buys like low, and he knows what things are worth, and he's buying mature companies. He's never investing in startups and things like that. Being an investor at that early of a stage, what are your feelings around board and advisories? Because a lot of the times you talk to founders and such, they feel the need that they always have to bring on a new investor. They always have to give a board seat, and I always tell them, like, board seats are scary. You got to be careful with board seats, because it's okay when it's just you and like maybe a couple of founders and whatever. But as this thing grows, the board seat becomes basically a rumble, right? It's a boxing match if you're not careful. What are your thoughts around that stuff?
I think it really, you cannot ever overemphasize the importance of a good governance, right? I mean, good advisors and good directors will absolutely help a company grow and bring a lot to the table that's required in terms of strategy and oversight, and really keeping the CEO accountable, because who else is the CEO accountable to? Founders aren't really used to being accountable to anybody. But I will also say that in the really early stages, having too formal a governance structure can slow you down. I've seen startups where they've got a full board that has to go through all kinds of, it's hard to make quick decisions, which you have to do in the early stage. But I think the best companies I see know how to pull together some advisors in the beginning, which is, you have 2 or 3 people that have expertise in area in your area,
Hmm.
or have connections to capital or whatever it may be, but they bring something to the table for you, and that it's not necessarily like a formal meeting every month or
Yeah.
quarter, but they
It's
have
almost
people
like
that
a
they
mentorship, right?
exactly,
Yeah.
exactly. But it's important to then get used to being able to utilize those people, get into some sort of cadence, because by the time you get to your Series A, you should be establishing a board, and that Series A lead investor will want a director seat and should so, because they've got a chunk of your equity now
Right.
and they've put in a decent amount of money. But do you need to build a big, and formal board at the beginning? Probably not. But you should be keeping an eye on that and thinking about it as you go through. A board is not
Right.
meant to be there to slow you down or antagonistic. They're there to support you, provide some accountability so that you actually hit the goals, and
Hmm.
open up doors for you in terms of investment or expertise and networks.
And I love that you said advisory. What is to you as the investor?
Hmm.
I come to you and say I have these three advisors. How seriously is that taken in comparison to like a board members?
I typically go past just looking at who they have as a logo, if you will. Like it's
Yeah.
just like having customer logos, and the questions are like, okay, well, how do you interact with them? What
Yeah.
are they guiding you with? How often do you meet and talk? Um, that
Because
is really
I'll be honest, I've seen a couple pitch decks where they've dropped name, like it's name dropping,
yep,
right?
yep, yep.
And I'm like, this guy is your advisory. Like, tell me more. And he's like, they couldn't explain to me. Like, you know
Yeah,
what I mean? It was like basically over coffee. They're like, hey, do you mind if I put you in my pitch deck? And they said yes. And
yeah,
in they should be careful with that, because
yep,
then if you're just too many, but they're also building their brand, right? Oh, I'm getting exposure. Oh, I'm
yep.
part of this. I'm part of that. I'm part of this, right?
But I
Um,
think a key question that I'll ask is just, what's the most valuable thing this advisor did for you? What's the best piece of
that's a good
advice?
one.
How did they actually help you move the needle? Or is it somebody that just agreed to sign on? And you haven't actually interacted with them yet, but they're going to interact with you in the future, which is again okay. But I want to know there's a plan versus, like you
Yeah,
said, this is just a name we wanted to have on there, right?
I love
So
that.
yeah,
That's a really good way to understand. Like, is he real or is he just like a name drop? That's a good point.
yeah, exactly, exactly.
Um, Okay, so like for example, you're in a situation that you're able to seek out investments. People are coming to you, "Hey, Arden, I have a startup. I'm looking at getting invested." What
Hmm.
are you as the investor looking for specifically? What is it that you're, you know, I know like you mentioned, everybody has their thesis and things like that. Let's go more general, right? Let's pretend like the business model is less of a case. What are you looking for in your pre-seed C or pre-series
Yeah,
A seed
yeah.
investments?
I mean, I think for us, right, our fund, like we don't come in before there's revenue generally. Like if it's a software company, if it's a not software, I mean, I should mention our fund is somewhat sector and industry agnostic.
Okay.
But if it's not, then there's, if it's like say life sciences or medical
Uh-huh.
technology, we're looking for data, right, milestones, regulatory hurdles, stuff like that. So, but what we want to make sure that we understand is there some early proof of product market fit, that you are selling something that there's a market for.
Right.
And then the next questions we try to answer, whether at that point or down the road, is okay, now can you sell this at a profit at scale? Right?
Right.
That's really the ultimate thing we're trying to solve. Where we come in, there's not a lot of financial history, and there's not a lot of ratios you can run. There's
Never.
not a lot of, and things like margin are not going to be. They're hopefully only going to get better. They're often you don't
Yeah.
have scale yet. So what does it mean? Well, we're looking for. I mean, and everybody talks about, oh, we're focus is on team. We want that. What does
Yeah.
that mean, right? Like
Everybody says that. Everybody. I
everybody.
even say it, to be honest. I
Exactly.
the way let me present how I think of it, and I'm
Yeah.
curious of what your thoughts are on it.
Sure.
My whole thesis behind team is you have to express to me as the investor why you're the person who's going to take it to the next level, why you are going to be the one that actually executes versus 1,000 other people that probably have had the same idea. That's
Yeah.
my entire model of team. Like, how are you going to execute? Because execution is the hardest part about startups.
Yep. Yep. And and that's fair. I don't know that any founders or all of them are always able to say this is exactly why I'm the
Yeah, fair.
they can have a belief or whatever, and it's important for them to understand their own value proposition. We look for clues in terms of like, what's your industry experience? How did you come about this
Mm-hmm.
problem? What does your
Mm-hmm.
team look like? I will always prefer generally to invest in a technical founder over somebody who just has general business experience, because we can introduce them to business,
Non-technical. Yeah.
right? And so the team
But
is important.
I feel like non-technical founders are a lot more charismatic, more sales
Yeah, well,
oriented.
and they should be, right?
Yeah.
I mean, because that's part of the value they bring. So what I'd like
Yeah.
to see a team generally around the founders, right?
Mm-hmm.
So do you have a good combination of business and technical skills? If they're lacking in business skills, that's fine. We can introduce them to people. If they're lacking in technical skills, that's a different story. Because now it's like, well, what are you doing that's so special here? I think
That's, by the way, that's the whole model of Corridor is we partner with non-technical founders because we realize the gap of the technical side. So like
absolutely
literally
that
we come in with
interior.
that business, like, all right,
Yeah,
we're going to come to you at the technical level of the business strategy. This
yeah.
product is not going to work. Here's why it's not going to work. And here's how we can make it work. Right.
Absolutely, absolutely. Because business is business at the end of the
Business
day,
is business. Yeah,
and
exactly.
there's a lot more of those resources we can tap into.
Yeah.
So I will say there's qualities we look for, right?
Okay.
So coachability is one. Definitely, like some of the best founders in our portfolio are the ones that even while we were, for example, negotiating the terms on a deal, they weren't just adamant on this is how it's going to be and this is what they were able to ask questions and be curious. Actually, I think
Mm-hmm.
curiosity is one of my favorite qualities. Is the founder that asks questions. Well, why is it like this? What can give? What do you need to see?
Yeah.
What why would we be a fit for your fund and vice versa? Founders that ask questions, I always enjoy because that means they have a desire to improve and
Yeah.
learn.
And
And
it's not
startups
just
is
about the
learning.
money. Because
Absolutely,
a lot of it, what happens is, are you going to give me money? I don't care. As long as you give me money, I'm good. We'll be partners.
yeah,
Yeah,
yeah.
because you got to
And so,
select the VCs just as much as the VC is selecting you. That should be the
oh,
best case
absolutely.
scenario.
I mean, I'm always impressed when a founder asks me if, for example, can we talk to another one of your portfolio companies,
Oh
right?
wow,
Somebody like
referencing
you should
you.
be, yeah, you
Wow.
should
Okay.
be,
Good.
right?
You
I
should be,
think
but no one does that.
no one does that, but I actually really appreciate a founder who comes up and questions us on the value because it's a long term relationship, and you
Yeah.
want to know that you're there for more than just the money, right?
Yeah.
If possible.
Totally. I agree with
I
that.
think another quality we look for again, like the curiosity and the team. And at the basics, it's like we're trying to answer the question of, do we believe this team can overcome challenges that come their way? I want to know how they work together, what they've worked on together before, because the truth is, anybody who's invested in early stage companies knows what you end up with down the road is not what you're starting out with. That
Complete.
product will pivot, that concept will change.
The
Can
amount
the
of
team
times
deal
we
with it?
say that out loud on this podcast is actually insane. It's
It's
I
true.
say this to every startup too. I'm like, look, what you're starting with, pivot. Just always remember you're gonna have to pivot. So have some cash flow for
Yeah,
that pivot. But
yeah.
do you think the reason that happens is because they truly don't do the research? I find that it is relative to the research. It's the ones that, and I'll explain. Let me explain.
Okay.
Okay, hear me out. Hear me out. So, what I realize is that it's the guy that comes to you and says, look, I have an idea. Here's what I'm thinking of building, right? And sure, it sounds like common sense. That makes sense. But they lack the aspect of coming and actually having those conversations with real customers. And what
Mhm.
they end up doing is just building and then having the conversation. And then the customers are sitting there going, yeah, no, actually, that's not much of a problem, but this is. And then they pivot.
Yeah. Yeah, and where we come in, they've already got customers, right?
Yes.
And that
Yeah,
they're
market
delivering.
fit.
This is what I come back to, that the curiosity, right? And the willingness to be asking questions and learning, because even if you've got early product market fit, as you grow, as
Yeah.
your customer profile changes, as you scale, you're going to have to make changes.
Yeah.
No product and delivery service, there's something about your business that is going to change as you grow. And it should, because if it doesn't, then you're not growing. You're at
Yeah.
scale. I mean, a good sign of growth is that things break, right?
Yep.
And systems break, and they should. If they're not, you're not growing. And so the founder, I think, that is most resilient is the one that understands that and is ready for it and builds a team that can overcome those challenges and that's willing to kind of, change with the times or the information, like you said, the research.
Mm-hmm.
So beyond the team, I'm personally, I think as investors, the team, the technology, and the market, right? And I think every investor has their own emphasis on, their own bias or whatever it is, their own
On the
thesis.
team.
I'm a fan of big markets, no surprise coming from a public equity background.
Mm-hmm.
I like to understand that there's a lot of potential because if you're going to, build a big company, you need a big market. Now, that doesn't necessarily mean I want to see that you have, this is a big TAM, this is a big whatever. What I'm really trying to get at is, who are you? Where could this go? Is there a big unknown, which is also exciting because it means you may be creating a market. I think it's easier to identify a small market than it is to identify a big market.
Yeah.
Right? So it's easier for an entrepreneur to say, I'm honing in on this market and it's kind of niche. And we can say like, okay, I don't think that that's going to be as we'll say a big of enough market for a venture backable market. But if you're kind of like, this is our first market, we think there's a bunch of other applications, but we're going to start here. We're not quite sure where it'll end up. Like that's exciting.
That is
right?
exciting.
Because there's a lot
because
of
that's also realistic.
It is exactly. It is realistic
because you need your niche in order to grow and to penetrate the market. Because frankly, if you're not niche, why are you making a product that's it's already out there? That happens sometimes, and we always ask them, "What's the niche? What's the penetrator?" Right?
Yep.
Once you get that niche, then you can expand out. Then you can build outside of it. Then you also understand your customers significantly better. It's kind of funny you're saying that because in Silicon Valley, if you go there, the bigger funds, they won't even talk to you unless you're going for unicorn status. Like they don't care. They're just like, how are you going to get to unicorn status in 6 years?
And I think, we kind of talked about myth busting, and I think that is something I think a lot of entrepreneurs and even investors need to understand. You can't look to Silicon Valley or any other market, quite frankly, as this is how it's done. Investing dynamics are so local and regional, right? In terms of investors, entrepreneurs, the resources available, the markets they play in, that you really have to understand what's going on in your market. And you can't, they do what they do in the Valley because they have the economics and the resources and the talent to do so. So to use those kinds of measures and then say, well, here in Alberta, like we should be doing that. That is a misapplication and understanding, right?
And we always
you're not going to be a billion.
And we always say like the talent just doesn't exist in Alberta. Like actually in most cities, it's not even an Alberta issue. You got maybe a handful of cities that have the capability or have the talent for you to hire to take to that next level. In most cases, that doesn't exist. Like in Alberta specifically, let's talk that. I think there's a lot of talent to be able to help you to get at least a Series A. But after that, you have to look outside the province.
Absolutely. And something that this is kind of my soapbox is, when we focus on startups, we focus on founders. But when we focus on scale ups and growth, we need to focus on talent.
Yes.
And one of the challenges and things that we need to do in this province is start connecting our growing companies to talent that's not available here locally. So and also fostering and growing the talent here. Like there's not a lot of sales VPs here in Alberta that have experience in SaaS.
Not a chance. Oh my God. Sales is one of the hardest things to hire for.
Exactly.
Especially for SaaS. Because it's just, you can't grab someone from retail. That it's a completely different ballgame. Here in Calgary, oil and gas, awful. Because the only way they know how to sell is partying and relationship building. Right? Like it's like hook me up and I'll hook you up kind of a mindset here.
And that works for certain industries, right?
It does. It does. It works great for oil and gas. That's what oil and gas is. But software, no. You're not isolated to the city. You have to sell anywhere in North America, and you can't just get up and have that relationship.
Yeah, absolutely. And so I think, we do need to turn a bit of a focus here as you're growing, for all the startups listening, don't be afraid to start looking for talent for senior level management outside of this province. It's so much easier. Like post-COVID, it just made it so much easier to hire remotely. And we should be taking advantage of that. The whole idea, we need to build up the Alberta advantage, if you will. You do that by hiring people that have experience that we don't have here and getting people here trained up with that experience so that when they eventually exit and, their companies exit, now they can come back, and that's how we build capacity. We're not there yet.
Bang on. Right? Because I think the biggest problem that Alberta has is they're trying to focus on bringing people here into the city, where after COVID, that just doesn't make sense anymore. Like our VP of marketing, Vancouver, our operations, it's in Mexico, right? Yep. Like our operation person is in Mexico from Calgary. But we've tried to be like, hey, do you guys want to come back to VP of marketing, cheaper living in Calgary? It's easier to live here. Everything is less expensive. Nope, they don't want to. They just simply don't want to move to Alberta, right? And I think having that mindset of trying to move people here, I think you're bang on. Instead, help them hire, blow their companies up so that the talent starts learning in Calgary.
Yes.
I love that. That's phenomenal. That's exactly what needs to happen. I love that statement.
And that's how we start really growing the scale of our tech innovation community here.
Yeah. And I think one of the biggest thing is as a founder, I don't think they realize, how do I say this where it's not like aggressive, but essentially, I don't know why they think that everybody cares about their hopes and dreams. And you mentioned that. And I love that statement.
Yeah. So when we were talking,
I was trying to be like very sensitive about it. You just can't, right?
I'll tell you the story. Okay. So where that came from was I was on a panel here in Edmonton last year for Startup Week, talking about investment and such with a bunch of students and young entrepreneurs. And at the end, one of the entrepreneurs or students, I'm not sure, but a young guy goes, "You've talked a lot about what you like to hear from founders and such. What is something that you don't really care to hear about that you hear a lot of?" And instinctively, I just blurted out, "Your hopes and dreams," and it got a laugh. And then I had to qualify that. I said, "Now look, I'm not saying that I'm some sort of uncaring prick, but what I'm saying is the number of entrepreneurs we see who want a certain valuation or want to raise a certain amount of money or whatever, and they're not getting it. The market is telling them, no, we're not going to give you that much." And their response is, "If you could only see what I see." And my response is always, well, you could only see what I see. I see the biggest saying the same thing. And that you have to understand that we need evidence. We need some sort of proof or something beyond your hopes and dreams, because every founder has hopes and dreams, and every founder should believe that they're going to be the category killer, the biggest in their whatever it is. But the fact is, you may be the best in this category. We get to invest across multiple categories. And if somebody else is going to be the best in another sector and giving me better pricing, when you look at just the financial instrument part of it, as an investment, I'm going to go with the better pricing. And I have to invest in your sector in order to get that, right? Yeah. And so, hopes and dreams are great, don't get me wrong, but we need evidence.
It's kind of funny because, you hear that a lot, right? Where they feel like they're losing a track, they're losing everything. And they're just like, I wish they could just see what I'm talking about. And they just never put themselves in the perspective of the VC, right? They'll call it, oh, they're such vultures, or they'll, well, yeah, true, fair. They're all about the money, which is what they're like. We just talked about at the beginning of this podcast. You guys have people to answer to, right? And like they don't there's a lot of factors that I feel like founders do not understand about the whole VC world and the investment world, where you guys have someone you have to respond to, right? As to why you made that bet. And secondly, you guys see 10, 20 pitches a month
or more
minimum or more, right? Like if it depends on how big your fund is, but like you're seeing almost the same idea in just rinse and repeat model. over the
Yeah,
year.
or even literally the same idea.
I literally say this, by the way, because we do the workshops, we do boot camps. So I meet a lot of startups all over the US and Canada. And every time I will tell you this, every time I go to a different city, I hear almost the same idea from a different founder. Almost.
There's
Like,
some universal truths out there. Yeah, absolutely. And I think, I mean,
hence why execution is so key, I find.
Yep. And entrepreneurs need to understand too, as an investor, as a good investor, I have a duty to my clients to make them a return.
That's
and
right.
so the first question every good investor, every real investor should be asking themselves is, can I make money on this? And if so, how much? That's number one. And there's nothing wrong with that, because if you otherwise you're not in investing, you're in philanthropy, right? Because if all your capital goes to zero, you can't do any more investing and you'll never raise another fund.
Not
right?
a chance.
At the end of the day, you have to make returns to keep this engine going and be able to support more. And so I have seen, VC Twitter is definitely a place you can go to and get angry if you see all the conversations that go on. And I always find it interesting to hear opinions of we need to, investors need to take more risk and invest in even more companies that could likely go to zero in order to. I'm like, nah, I don't know. I don't know that that's an institutional investor's place to take that kind of risk. Maybe it's government's place, and maybe it's private individuals' place to take more early stage bets on higher risk. But I have a duty to my investors, and they have a duty to their pension fund members, right? Be making a return. So let's not forget that we are in the business of money management, and that's the reality.
Yeah. Right? What is the typical return you guys are wanting to see? Because actually, here, maybe this will help them with perspective. How many deals out of 10 would you say go to zero on average for VCs? Not necessarily yours, but because you guys are making that calculation. You guys are making a calculation that
for sure.
If I'm giving 10, I'm losing this many deals.
Yeah. I mean, and there is lots of literature out there on the internet, about the VC model, right? The power law, how on average you have to, the average, the rule of thumb is, a third of your portfolio goes to zero, about a third of it might give you a 2x, and the rest of it kind of, you'll get one or two companies that make the fund. And that's the average power law. But that's also, let's remember that that's kind of based on, again, the Silicon Valley model and, a certain number of companies. There's different, now coming from a capital markets background, I understand there's different ways to build a portfolio, right? And so, for example, for us, because we don't see as many deals as someone in the Valley would, we know that we're going to have a smaller opportunity set. And that means for our fund and the size that it is, we kind of, need to come in a little bit later where there's revenue and the risk has come down a bit. And what we aim for isn't necessarily the one company that's going to make the entire fund. We're expecting, a couple of them will go to zero. A few of them will break even, but if a third of the portfolio kind of brings back, it doesn't have to be a 50x, right? It doesn't have to be whatever. If they can do a realistic return, and
what is that? What is a realistic return
in Canada? Good startups.
Okay, here, let's get Canada and then one in the States, and then that's going to lead me into the conversation about Canada versus the US.
Absolutely. when you look at sub 500 million for sure is what Canadian exits are at, right, in venture.
Yeah, sub 500. Yeah, that's
and that'll vary from 50 to it depends on the industry, right? So we do that analysis in our in our due diligence. We kind of look at, in this sector, this is where the exits are roughly. If you're in life sciences, $1 billion plus for sure. Semiconductors, absolutely.
Yeah,
SaaS software,
that's international. Yeah.
Right, 200 million to 500 is kind of the range you're looking at for
if they stay in Canada, or
generally
if they stay in Canada.
If they're headquartered in Canada and they stay here, right? And I'm talking about a private acquisition.
That's so annoying, but I agree with that.
But I mean, that's at the end of the day, that's just
reality.
The market. Yeah. Right. And that comes to how fast you can grow your revenue. And there is a school of thought historically that Canadian founders tend to exit too early.
Yes.
They
Oh,
want money on
always.
the
Oh my
table.
God. It's so frustrating. So we were at this, I just want to tell this side story
Yeah,
because that's so relevant. I was in a room back in the day, had my own startup. I was in the room and basically this gentleman, Randy, he's from, what's Valhalla, group.
Randy Thompson. Yeah, I know
Yeah.
Randy.
Yeah. That's right. Him. And he was at the front presenting. And I really like Randy. Randy is very honest, and he'll hit it. He'll just say it like it is. And I love those kind of people. That's the type
Yeah.
of people I like to surround myself with. And he said, "All right, so how many of you today, if I gave you guys $1 million right now, how many of you guys would walk away from your idea?" And I'm not kidding. I was at the front, right? I was that eager student. I'm just trying to learn and absorb. And I'm like, I kept my hand down. Me and my partner, we kept our hand down. And we're like, of course, that's stupid. Why would we ever give away the idea that fast? And he's like, exactly. This is what we have to deal with in Canada. And I'm like, what? And I look behind me. I kid you not, I would say 95% of the classroom had their hands up. And I'm just like sitting there going, are you guys crazy? Why? You haven't even seen the opportunity of this thing. Yeah, it could go to 0, but it could also go to 20 million, 30 million. Like, it's just the Canadian mindset is so conservative. It's so sick. I got my money. I'm out. I'm chilling.
Yeah.
I'm good.
Yeah. Yeah.
I agree with that. I don't know why. That's such a weird mentality to me.
There's a whole bunch of theories and ideas around that we don't have enough time to get into here. But I think it's important to understand is that we have a different culture up here.
Yeah, that's
right. And when I'm investing in Canada, I have to understand that.
That's right.
Versus if I was investing in the Valley and seeing that kind of deal flow and looking at the growth rates and the opportunities available to those companies, I would be like, absolutely, I'll pay you a $20 million pre-money valuation because you'll likely get an exit that will make it worth my while. If you're in Canada, I'm reducing that by a factor of like 5, easily, not 10. So context matters, geography matters, markets matter. Investing is not a monolithic thing that you apply the same rule to every single market you're in.
Yeah, I agree with that. And it's and one of the other things is an American money cycle is like 3 to 4 years for an American investor, whereas a Canadian investor is usually 7 to 9? Yeah, 7 to 9 years. So you're like, an American will make 50 times twice before a Canadian makes 10 times once.
Absolutely. And again, those are the dynamics that we're dealing with, right? True. I mean, for a company in Alberta to hit 10 million ARR, that is a huge accomplishment, right?
Yes.
In SaaS.
Oh yeah.
For a US company, if you haven't done that in the first 2 years that you've been around, you're probably not going to go very far, right? It's like, and that's an exaggeration, but getting the point. We look at things differently. I was in the Valley at SaaSer last year, and it really hit me how aggressively they think when I was watching a talk by a CEO of HashiCorp, public SaaS company. He's talking about the different stages of growth and how you have to change your processes. And he said, he put up a slide and he says like, well, up to about 10 million, you're still kind of working out your product market fit. At 30 million ARR, now you've got product market fit. And at about 100 million ARR, you're ready to scale. I was like, well, you drop a 0 off of those and you've got the Canadian market. I'm like, at 30 million ARR, we're probably exiting here.
Yeah, 10 million. Oh my God, 10 million ARR. I'd be throwing my money at that company.
Exactly. So it's a very different game in scale.
Yeah.
And I think,
and they're playing with bigger money, to be honest. Like that 10 million, your valuation is $250 million minimum. Right?
And it's a denser customer market that they can reach faster than you could up here.
That's right.
And that's the reality of it, right?
Yeah. Arden, we can talk all day. Let's be realistic here. And I love having these conversations with you because I think you put in a really good perspective for the VC side, because I think that's the number one thing that's always missing with founders is they lack the understanding of whom they almost don't see them as human, right? They see them as like cash flow. If I don't raise the money, I will die. So, I need you. And I love having these conversations with you guys, especially you, Arden, is that you're genuinely blunt about, look, I don't care about your hopes and dreams. I just simply want to know how am I going to get my money out? Because I have people to answer to. And I love that. So I really appreciate you taking the time to come in on this podcast with us and talking some real talk. So I really appreciate it. You got to come back though, because I don't think we're done. I know our time is coming up. You're a busy man, but I feel like we can have at least another podcast of 45 minutes easy.
Well, I'll tell you this much. How about this? I'm going to throw a challenge for your listeners out there to ask you about some questions. And we talked about myth busting.
Oh, I like that.
Let's get some input from your audience. What are some myths that you would like us to talk about? And what are some topics in VC that you want to bring up?
And then you and I are going to do a Q&A.
Okay, yeah.
I love that. I love that. Okay, audience, you heard it here. Okay, any questions you have that you want to pose to Arden or myself, and we'll do it together. So anything about product, anything about startup, pre-seed, seed, whatever you want to know, post up the questions. I'll coordinate with Arden and we'll do a Q&A, just ad hoc. We'll make it super flexible, easy. Ad hoc. We'll do a Q&A together and we'll answer your questions. I love that. I love that idea.
All right. I mean, I would say your most interesting question, whoever comes, they should get a guest spot or at least get to film their question. And we can do it either live or on video to hear them. But I mean, let's get your audience engaged and let's make this valuable for them. I'm always happy to help out and to jump in their community with any sort of guidance. And I'm always willing to learn. I mean, I don't know everything. I'd love to hear perspectives from other investors and other startups, because the one thing I've learned in this business is that the moment you stop learning is the moment someone else
You're
is
dead.
going to
You're dead.
right?
100%.
So,
you can never stop learning. Absolutely agree with that. Awesome.
Sure.
All right, and maybe we can do it when you're in Calgary. When you come in, we'll do it in person maybe. That'll be even more fun. Okay, perfect. We have too many plans. Cool. Too many plans.
We'll make them happen. And I really appreciate getting being asked to be on your show, and I can't wait to do it again.
Awesome, Arden. Thank you so much. I appreciate you. Just hold on one second while I say goodbye to everybody for listening in and listening to Arden speak. As you know, he is experienced. He knows what he's talking about. And it was really nice getting his perspective of what the investors are. I know he's being humble and he's just nodding, but he knows more than most people do for sure. Until next time, if you like this episode, please share it with anyone that you think could get some value out of this. Otherwise, like, subscribe. And until next time, Corridor out.